Most approaches to portfolio construction rely on estimates of expected return, standard deviation, and correlation. Although investors usually rely on proprietary models or notions of equilibrium to estimate expected returns, they typically use historical returns to estimate standard deviations and correlations. It is widely known, however, that different return samples often lead to substantially different estimates. The period-specific nature of these values suggests that returns may not be generated by a single regime, but rather by multiple regimes, perhaps a quiet regime and a turbulent regime. We have therefore developed a methodology for identifying those returns that reflect quiet periods and those that are more likely to be associated with turbulent environments. We use this partitioning to estimate regime-dependent risk measures. In most periods, there are no significant events to cause asset prices to change meaningfully. The returns we observe mainly reflect the fact that prices are noisy. Yet other periods contain important events, such as Russia's default on its sovereign debt in August 1998, which legitimately cause investors to revalue assets. The normal approach for calculating standard deviations and correlations places as much emphasis on those returns that merely reflect noise as it does on event-driven returns. Our methodology allows investors to estimate volatilities and correlations separately for quiet periods and turbulent periods. Consider a sample of domestic stock and bond returns. We begin by locating each period's returns for stocks and bonds on a scatter diagram. In most periods, the returns tend to be close to their means and consistent with their correlation. However, there are periods when the returns may deviate significantly from their means and in a way that is counter to their normal covariation. These relatively unusual periods are often associated with important events, such as Russia's default. We next overlay a circle on this scatterplot whose center is located at the average of the returns. The distance of the circle's perimeter from the center represents the boundary that separates quiet periods from turbulent periods. Those months whose stock and bond returns lie within the circle are associated with quiet periods, while those months that lie outside the circle are more likely to have event-driven returns reflective of turbulent periods. Although we can observe which periods are within the circle and which are outside of it, we need a mathematical procedure to make this distinction. We therefore construct a circle for each observation on the scatterplot. The centers of these circles are all the same, the average of the returns, but their perimeters pass through each observation. We then compare the radius of each circle with the radius of the circle that defines the boundary between quiet and turbulent periods. If it is greater than the boundary circle's radius, it resides outside the boundary and represents event-driven turbulent periods. If it is shorter than the boundary circle's radius, it likely reflects noise. This approach is appropriate for uncorrelated assets with equal variances. It is more often the case, however, that assets have unequal variances and that they are positively correlated. In these more common cases, we replace the circle with an ellipse whose slope reflects the asset's correlation. Again, we distinguish quiet periods from turbulent periods depending on whether the observations lie within or outside of the ellipse's perimeter. We can extend our methodology to incorporate a third asset, foreign stocks for example. We now locate the observations representing each period in a three-dimensional scatterplot. One dimension represents domestic stock returns, the other domestic bond returns, and the third foreign stock returns. We now use an ellipsoid-shaped bubble to mark the boundary between quiet periods and turbulent periods. As in the case of two assets, those periods whose return combinations reside within the bubble reflect quiet periods, while those outside the bubble represent turbulent periods. Although we're limited to visualizing the application of this methodology to only 3 assets, mathematically it can be applied to any number of assets. Having partitioned historical returns into those associated with market turbulence and those reflective of quiet periods, we next re-estimate the standard deviations and correlations that prevailed during these sub-periods. We then use this more refined characterization of risk to construct portfolios that are more resilient to market turbulence by blending the standard deviations and correlations according to our attitude towards risk, or based on our expectations about the relative likelihood of quiescence or turbulence. This refined approach to risk measurement reveals a variety of insights about the time-varying nature of risk. For example, it reveals that financial assets provide less diversification during stressful markets when diversification is most needed than during quiet periods, and that real assets often provide incremental diversification during stressful markets. It also shows that country diversification within asset classes is less effective during turbulent periods than asset class diversification within countries. Finally, we can stress test an existing portfolio by calculating exposure to loss under the assumption that the standard deviations and correlations from turbulent times prevail. We typically find that a portfolio's probability of loss and value at risk rise during turbulent environments. For investors who seek a more sophisticated approach to risk management, we offer a superior solution.